So on the handout, we're actually going to skip down to 3 first because it just does a complete stock option. And then we're going to go back to 2. I should flip the order of these because it does a stock option where you actually have forfeiture. So I want you to see a full stock option first, and then we'll look at, well, how do we treat a forfeiture in problem 2? So we're going to start with problem 3 on your handout. But before we do that, let's talk a little bit about stock options. Now, we've already talked about restricted units where we give them shares of stock. What a stock option is a little bit different. A stock option gives the employees the option to actually purchase shares in the future. So it gives you the right to buy so many shares of the firm's stock at a specific exercise price. Now, remember, this is set in advance, so we set it today. So an employee would want to take advantage of a stock option if the market price is greater than the option price. So in other words, I give you a stock option, you can buy 1 share at $3 in the future. Well, when we get to the future date and that share of stock is selling on the market for $8 a share, well, naturally, you're going to want to exercise that option. You're going to want to pay the 3, and then you can turn around if you want to and sell it for 8. You automatically make $5 on that share of stock. So when we talk about stock options, you don't actually give them shares of stock. You give them this little thing that says, hey, at some point in the future, usually after some specified period of time, you're allowed to buy X number of shares of my stock for a set price, okay? Now, the option itself has a price value, and we're not going to look in this class at how to price an option. There's a whole pricing model for options that's beyond the scope. We're just looking at how to account for those options. We have all these other people that do the pricing models. We just look at it. But historically, options are measured at their intrinsic value. And the intrinsic value equals the market price of the shares minus the option price at which they can be acquired. So in other words, an option that permits an employee to buy a share of stock with a market price of 25 for 10 has an intrinsic value of $15 per share. But now compensation is measured at the fair value of the stock option itself on the date of grant. And again, that's where the option pricing model comes in. So at this point in time, to decide the total amount of compensation to our employees, it doesn't matter how much they buy the shares for, it's based solely on the value of the option itself at the date of grant, okay? We record that amount as compensation expense over the service period. So just like the restricted stock units, once we come up with the value of the compensation, we divide it over the vesting period, how many years they have to work for us in order to become eligible for this compensation. The fair value of the option is actually estimated by employing a recognized option pricing models. So what are option pricing models? Well, what they do is they take into account several variables to come up with the price, such as the exercise price of the option, the expected term of the option, the actual current value or current market value of what the stock now, any expected dividends in the future, the expected risk-free rate of return during the term of the option, and that's where perspectives come in, and then the expected volatility. So again, models take all of that into account for us, and there's different models there that they use. Again, in accounting class, we're not actually going to learn this. We're just going to learn how to compensate it, or how to record the information. So if you want more on option pricing, you can dig a little bit into finance and see how those options are priced. So that was a little bit of a background about what a stock option is. So now let's look at this example. How would we actually go in and record or deal with stock options? So SSG Cycles manufactures and distributes motorcycle parts and supplies. Employees are offered a variety of share-based compensation plans under its non-qualified stock option plan. So this is this non-qualified stock option plan. SSG granted options to key officers on January 1st, 2018. The options permit holders to acquire 23 million of the company's $1 par common shares for $12 within the next 6 years, but not before January 1st of 2021. So notice we granted these on 2018. They're not allowed to exercise them until after January 1st of 2021. So they have to hold them all of 18, all of 19, and all of 20. So that brings about a total of let me get up here, a 3-year vesting period. That's important. Be careful, we don't include all of 2021 because they can actually exercise them beginning January 1st of 2021. So they only have to work 3 full years before that vesting period ends. The market price of the shares on the date of grant is $14. The fair value of the 23 million options estimated by an appropriate option pricing model is 3.6 per option. So again, what we know this. The option price model gives us 3.6 based on some of those variables we talked about before. So how do we get our total compensation? Well, when we have a stock option here, the total compensation would be go in and take the 23 million shares. We're going to take that 23 right here, 23, and we're going to multiply that by the option price of 3.6. And when we do that, we come up with 82.8 million. So that's 23 million shares at $3.60 per share, or per option, excuse me. So 23 million options at 3.6 per option gives us 82.2. So just like before, we simply take the number that they're allowed, multiply that by the price per option at that time, the estimated price, and that becomes our total compensation expense. Now keep in mind, we do not recognize all that up front. That's actually going to be recognized at the end of each period for the vestment period until we end vesting. And once vesting is over, they've fully earned it. They are allowed to issue or exercise those options at any point after that. They have earned those options. All right. So number 2, prepare the appropriate journal entries to record the compensation expense for December 31st of 18, 19, and 20, the whole vesting period, and then record the exercise of the options if all of the options are exercised on May 11th of 2022. Not likely that they all would be. They don't have to exercise them, but some of them probably would. But here, when we exercise them, the journal entries become the same over time. Okay. The market price at the time of issuance was $15 per share. So journal those on the next page. Actually, I've got them all on one page for my screen, but on the actual handout, it is on a separate page. So at the end of January 1st of 18, again, we would not record anything on day 1. They haven't earned any of the stock options. But December 31st of that year, they have now earned. So how would we do that? Well, just like before, it's going to be compensation expense. This is actually comp to our employees. It would be subject to some form of tax at that point in time, but we're not going to ignore payroll tax at this point. Just understand how the stock option itself is recorded. So we're going to go in and hit compensation expense for 27.6. And again, that's simply the 82 million. We're going to take that 82.8, divide it over our vesting period of 3, and that gives us the 27.6. And just like before, what do we hit? Well, we're going to hit paid in capital for our, instead of restricted units, these are not restricted shares, these are actually stock options. So we're going to have a separate PIC account for this. And again, paid in capital, I do PIC, so we'll do that here in just a minute. So you go in and that would be 27.6. Well, what's going to be our future entries? Well, they're going to be the exact same, assuming no expectations of forfeiture during that period of time. In other words, we expect all the employees that have this option will remain for at least 3 years. So we're going to record all of those entries exactly the same over that 3-year period. All right, so not too bad. Stock options are not too difficult to account for when we break it down to just the bottom line pieces. Now, let's look at what happens when they exercise the option. Now, when we exercise it, keep in mind they're allowed to purchase. They don't give them shares. In the restricted stock units, we simply gave them shares of stock. That's not the case here. They actually have to buy those shares of stock. So when they exercise them, they have the right to exercise them at $12. Okay? So they're going to go in, and those 23 million shares, they're going to buy for $12 per share. So they're going to go in and they're going to hit cash. And we're going to take 23 million times our $12. Whoops. Okay, so multiply that out for us. When you multiply that out, hopefully you get 276. And since those all have points, I'm going to put 0.0 in there just to keep everything lined up nice and neat. All right, so that's first and foremost. Now, that's not all that our employee paid us. Remember, they paid us throughout the years by working for us and helping us generate revenues. So part of that has gone into our PIC for stock options, paid in capital for our stock options. So if we do pick for our stock options, how much went into there? Well, 3 years at 27, so that total comp I think was 82.8. There we go. So that's the amount of total investor pay in. So our employees paid us in cash 276, plus they earned 82.8 in compensation. So that needs to come out. Now, what are we giving them in exchange for all that work and cash? Well, we're giving them stock, and we're giving them 23, that's right, 23 million shares. We're going to multiply that by $1 par. I think it said our par was. So we're going to hit that for 23 million. So again, let me just double check. Yes, it was $1. I thought it was $1 par, but just had a moment there. So we're going to multiply that 23 by the $1 par. So we're going to take common stock. We're going to hand that out. 23 million shares are getting distributed to our owners here. Well, anytime we issue shares of stock, and we issue it for more than what the par is, what do we hit? Well, we hit PISA, paid in capital in excess of par, on our common shares. And really, this is just everything they paid in above par. So that's going to be 335.8. Now, keep in mind, they simply earned this. Now, should they exercise it? Well, technically, I think they paid more because in theory, we estimated 12 plus 3.6, right? They paid 15.6, but remember this 3.6 didn't cost them anything because all they had to do was work for us as normal, get paid their normal compensation for 3 years. So they're paying in 12, they can turn around and sell them for 15. So that means for each of those 23 million shares, they're going to gain $3. So if everybody sold their shares, that would basically be an income of what, $66 million, 60, something like that, 23, 20, 46, 69 million. So they get $69 million in instant income by just buying the option at 12 and turn around and immediately selling it for 15. I don't know that that's what they did, but they could if they wanted to. So that's just a nice little payday. But anyway, that gives you an example of how to record these stock options. Again, just simply take the number of options times the option price, calculated through an option pricing model, and that gives you your total compensation. You divide that across the years until you are vested. So if there's a 3-year vesting, a 4-year vesting, a 5-year vesting, whatever it is, take that total comp, divide it over the years till vested, and then that's the allocation you do each year for our compensation expense. Then when they're exercised, we take the number of shares they exercise times the price that they're allowed to pay. That becomes the cash they pay in. We remove the pick from stock options, and then they receive the common stock. Any excess, of course, goes into PISA common. So really neat in that respect on how we calculate our overall value. All right, we'll look at the next problem here coming up. Is going to be another stock option, but it's going to be a stock option where forfeitures happen. In other words, employees quit during that vesting period and never are allowed to receive those options. Have a great day.